Welcome to the elite world of horological investment in 2026, where the boundary between art and currency has completely dissolved. If you are watching this, you understand that a luxury watch is no longer just a way to tell time. It is a portable and liquid asset that has outperformed many traditional stocks and bonds over the last decade. Today, we are stepping into the arena to compare the undisputed kings of the secondary market, which are Rolex and Patek Philippe. As we navigate the economic landscape of 2026, we see a market that has matured significantly, moving away from the wild speculation of the early 20s and into a phase of stable, long-term appreciation. Choosing between these icky brands is not just a matter of taste. It is a strategic decision that depends on your capital, your risk tolerance, and your investment horizon. We begin with the crown, which is Rolex, the brand that remains the primary gateway for watch investors around the globe. In 2026, Rolex has solidified its position as the blue-chip stock of the watch world. The biggest driver of Rolex value this year is the massive expansion of their certified pre-owned program, which has brought a new level of transparency and pricing structure to the secondary market. When you buy a Rolex, especially a professional steel model like the Daytona or the Master II, you are buying into a level of liquidity that no other brand can match. You can walk into a dealer in London, Dubai, or Hong Kong and convert a Submariner into cash in a matter of minutes. This high liquidity makes Rolex the perfect choice for the investor who wants to protect their principal while enjoying a steady and predictable growth. In 2026, we are seeing that the supply of new PCs has slightly increased, but the global demand for the icon models continues to outpace the factory output, keeping secondary prices comfortably above retail for the most desirable references. The Submariner and the Daytona remain the heavy hitters, but we are also seeing a fascinating trend in the neo-vintage market for Rolex. Models from the late 1990s and early 2000s are becoming the new darlings of the investment community because they offer a perfect blend of modern reliability and vintage charm. For an investor with a budget of $10,000 to $30,000, Rolex provides a diversified range of options that are almost certain to hold their value across economic cycles. However, you must be aware that the sheer volume of Rolex production means that rarity is relative. To see truly explosive growth in the Rolex world, you have to look for the rare dial variations or the limited production runs that the brand occasionally releases to celebrate major milestones. Now let us turn our attention to the pinnacle of high horology, which is Patek Philippe. If Rolex is a blue-chip stock, then Patek Philippe is a rare piece of fine art or a high-end real estate holding. The philosophy of Patek Philippe has always been centered on scarcity and craftsmanship, and in 2026, this rarity is more valuable than ever. While Rolex produces around 1 million watches a year, Patek Philippe keeps their production strictly limited to about 70,000 pieces, which ensures that there is always a hungry market for every reference. The transition from a legendary 5711 to the newer 5811 has created a massive ripple effect in the market, making the older Nautilus models some of the most sought-after vintage pieces of the modern era. Investing in Patek Philippe requires a much higher entry price, but the potential for explosive growth in the auction market is far greater. You are not just buying a watch, you are buying a seat at a table of elite collectors, where the provenance and the rarity of the piece can lead to life-changing returns. The 2026 market has seen a resurgence in the popularity of complicated Patek Philippe watches. While the sports models like the Nautilus and the Aquanaut dominated the headlines for years, serious investors are now looking at perpetual calendars and world timers as the true value plays. These pieces represent the soul of the brand and are often produced in even smaller numbers than the still sports watches. When you own a Patek Philippe with a grand complication, you are holding a piece of mechanical history that transcends fashion trends. The old saying that you never actually own a Patek Philippe, you merely look after it for the next generation, has become a literal financial reality as these watches are increasingly used as tools for generational wealth transfer. The choice between these giants in 2026 often comes down to your exit strategy. Rolex is the king of the short to medium term because the market is so vast and the brand recognition is universal. Everyone, from a taxi driver to a hedge fund manager, knows the value of a Rolex. Patek Philippe, on the other hand, is a long game. It is a generational asset designed to be held for decades. We are also seeing a major shift in the authentication process this year, with both brands moving toward digital passports and blockchain technology to track the ownership and service history of their timepiece. This has significantly reduced the risk of fraud and has made the investment case for luxury watches even stronger. From a maintenance perspective, Rolex is generally more affordable and faster to service, with a global network of technicians who can handle even the most complex movements. Patek Philippe requires a much more specialized touch, often necessitating a trip back to Switzerland that can take months and cost thousands of dollars. As an investor, you must factor these carry costs into your total return calculations. A Patek Philippe that has been improperly serviced can lose a significant portion of its value, so maintaining a relationship with an authorized service center is vital. In the global economic environment of 2026, with its stabilized interest rates and renewed focus on tangible assets, luxury watches have become an essential part of any diversified high-net-worth portfolio. We are seeing capital flow from the volatile crypto markets and the stagnant real estate sectors into high-quality horology. Rolex remains the safe haven for those who want stability and easy access to their funds, while Patek Philippe is the choice for those who want to reach for the stars and capture the highest possible returns over a 20-year period. The rise of specialized watch investment funds has also provided a new level of support for prices, as these institutional buyers are snapping up the rarest examples of both brands to hold in their vaults. As you decide where to place your capital in